The purpose of this video is to go through the USDA waterfall and kind of what your mortgage lenders will be looking at if you have a USDA loan and you're trying to transition off of your COVID forbearance. If you're a subscriber to my page, good to see you. Welcome back. If not, make sure you subscribe and like the video, ask me a question, leave me a comment. I always try to reply to everybody as fast as I can. So USDA is a type of loan. It is similar to VA, FHA, Fannie Mae, Freddie Mac, and that it's government backed. And so if you know that you have a USDA loan, you're going to want to be paying attention to this waterfall video because this will kind of tell you how they will view you when you try to apply to transition off of your COVID forbearance. So if you're one of these people who took a COVID forbearance because the pandemic hit your household income, now it's probably time to transition off of it. And we're just going to talk about how USDA views you. So the first thing to understand is to be eligible for their kind of COVID transition options, the property needs to be owner occupied. So this does not apply to vacant or abandoned properties or rental properties. So you as a primary owner need to be like living in your home in a way to get one of these options. You have to be less than 100 days, let me start over. You have to be less than 120 days delinquent as of March 1st, 2020. So what that means is USDA views March 1st, 2020 as the start of the pandemic. So if you were more than 4 months delinquent prior to March 1st, 2020, they don't view you as somebody who has a COVID related hardship who is eligible then for the COVID transition options. Does that make sense? So basically 4 months worth of mortgage payments could be behind as of March 1st, 2020. But if you were more than that, your delinquency is considered not COVID related, and then these protections wouldn't apply to you. So if you're somebody who was current all the way up until the pandemic started and then you became delinquent, you've got nothing to worry about. If you were kind of like spiraling out of control prior to the pandemic and then the pandemic made everything worse, you might not be able to get some of these protections, and you should probably call an attorney in your state for help at this point. The other requirement that USDA has put out there is that you need to have already requested assistance. And so this is typically just means you asked for a COVID forbearance and you got a COVID forbearance. And so USDA wants to see these three requirements met, and they want to see that you had previously asked your bank for help in order to be eligible for the transition options. That's kind of like a no-brainer. If you're trying to transition off of your COVID forbearance plan, clearly you asked for help, but it is worth mentioning. So USDA will kind of view you as in one of two categories. And the first category is you are somebody who can afford your mortgage payment that you were making before the pandemic. So if you went through a financial hardship, but the financial hardship is resolved and you have no problem paying your original mortgage payment, you would be in category one, and USDA would offer you a payment deferral. A payment deferral is very similar to a partial claim or the Fannie Mae deferment program, where they literally just take the amounts that you missed during your forbearance, they make them due at the maturity date of your loan, or if you sell or refinance your house, and then you just resume making your original mortgage payments. So it's straightforward. Most of the government investors have an option like this available for you guys. And if you can make the payment that you made before, it's a good option. And it allows you to just kind of move forward and deal with the amount at the end of the loan that you missed. So if you miss 6 months worth of payments at the maturity date of your original mortgage, you'll have 6 months worth of payments due. That amount does not collect interest. They can't add fees to it. So it's not a bad option if you can resume your regular payments. They might look at what they call an interest rate reduction and a term extension as another option. This is just kind of a fancy way of saying they'll look at you for a loan modification, basically a restructuring of a new loan. It's different from the payment deferral because a payment deferral just gets you current on your original existing mortgage. A loan modification will actually write you a new agreement where you'll have a new principal balance that includes the amounts that you missed. You might get an interest rate reduction, and they might extend the term of the loan out longer. So your payment might change a little bit. So if you are really feeling like you need a little bit of a lower payment, you might want to see what you can do with USDA to explore this option of the interest rate reduction and term extension to see if they can kind of write you a new agreement. Different from a deferral because it actually is a new agreement. And then the third thing that USDA will look at is they're calling it a mortgage recovery advance. What that is a one-time payment paid from USDA to you to kind of help with the delinquency. And so this really is for people who are having more of an issue getting current, meaning their finances have not recovered in the way that we all kind of hoped that they would at the beginning of the pandemic. They're considering this last. So remember, these are in order. So first they want you to do a payment deferral where you just resume your regular payments, shove the amount you missed on the end. If that doesn't work, then they go and they see if a loan modification with a reduced interest rate or extended term will help you kind of get a lower payment. And if those two things are still not affordable for you, then they'll kind of look at the mortgage recovery advance one-time payment. USDA doesn't want to be giving those advance, right? No bank wants to like give money out. They always want to receive money. So it'll be interesting to see as time goes on who actually is able to get those mortgage recovery advances, but they are there. And so that all kind of relates to like category 1. Those are like people who can afford to resume payments in some way. And the way that USDA explains it is category 2 people are people who have had kind of a devastating financial hardship that has not recovered after the pandemic, and they kind of cannot resume things in any capacity like it was before COVID. And then what the USDA has said in kind of general terms is they'll review a combination of those 3 things. So if you're somebody who wants to keep the home, has some money still coming in, they might do some sort of agreement with you where maybe they give you a payment deferral and a recovery advance. So maybe the USDA pays a little bit toward your mortgage to lower the balance you owe, and then they defer the amount, right? Or they maybe defer some of the amount and they figure out a way to like also write you a loan modification. It's not really clear to me at this point, just because everything's so new, how it will look, but they have said that a combination of those 3 things, a loan modification, a payment deferral, and a mortgage recovery advance, might be available if you're truly facing kind of dire financial straits. So as we keep going, I'll try to be posting updates on how the actual process is going. As soon as I have some sample agreements, I'll get those up as well. If you have USDA, best of luck to you. They can be kind of hard to get a hold to, so make sure you call them every couple days, follow up. If they say they're working on something, try to hold them accountable. That really is your job out there. Good luck.